Hi, I'm Jason Ball. Welcome to Jason's Tips. I just want to let you guys have a little bit quick introduction here and let you know first off a little bit of housekeeping and disclaimers. This content is live stream. This content is for general education information purposes only. It is not financial, investment, tax, legal, insurance, or medical advice. No personal financial recommendations are being made. Nothing presented should be interpreted as solicitation, endorsement, or guarantee of results. Although I do hold a CFP, ChFC, and CLU designation, I am not acting as a financial advisor, a fiduciary, a tax professional, a legal representative, any way, shape, or form on this platform. All case examples, scenarios, and case studies are hypothetical and intended for illustrations, financial principles only. Viewing or engaging in this live stream does not create an advisor-client or fiduciary relationship or a planner-client relationship. As always, consult your own financial professional or legal licensed professional for advice about your individual specific needs. And with that, let's move on. I wanted to talk today about a solo 401k and a SEP IRA. Well, these are two things that individual business owners can use. Most people hear about, oh, a solo 401k, and these are for small businesses. And take a look at some of the ideas and contributions, limitations, and who they may or may not be for, and why someone may or may not use them. First thing kind of gets a quick thing to get thing out of the way. Both a solo 401k and a SEP IRA are powerful tax qualified plans. And that means that they get to either tax deferred or have tax sheltered in them, and they're done by the IRS. A solo 401k does provide a little bit greater flexibility with both employees and employer contributions, Roth options, and potential loan provisions, but it does require more setup, annual maintenance, and some costs to be able to do that. A SEP IRA is simpler to establish and maintain. It works if you have employees, but it lacks a Roth option and may allow lower contributions at modest income levels. Contribution timings and deadlines. Solo 401ks must be set up by the end of the year, while a SEP IRA can be opened up as late as your tax filing deadline, including extensions. Choosing the right plan depends on your income levels, employment status, tax strategy, if you do or have employee statuses. Let's take a look. First thing, if you're a full-time content creator, whether you're running a YouTube, a streaming as Twitch, selling stock photos, building a multi-brand platform, without an employer-sponsored 401k or your benefits, a traditional benefits package, it's easy to put the savings on the back burner and say, okay. I've also seen some people say, hey, I have a savings account and that's my retirement savings account. That's different just having an ordinary savings account than having a tax qualified plan based off the IRS guidelines. There's some additional benefits that you get within that for security and purposes, and there's additional tax benefits that go along with it that make it a really good option to look at some of the tax qualified plans. But here's the reality: every year you delay investing or you potentially lose some compound growth, and you also can lose some of the benefits of tax strategy. At a top level, the government put these plans together in order to encourage people to save for retirement, and they put some protections on these types of accounts to encourage so that people do not run out of money when they are in retirement and they can no longer work. So both accounts allow you to take large. So getting back. So let's look at the basics here. Understanding the basics, what is a solo 401k? A solo 401k is sometimes called an individual 401. And it is designed for individuals with no employees other than their spouse. And it allows you to make contributions to up to $23,000 in 2025 on as the employee, but it also allows you to make contribution as the employer, i.e. the tax business ID number, can contribute up to 25% of your net employment income into your single account. So your combined contributions can reach up to $69,000 in 2025 or $76,500 if with catch-up provisions if you're over age 50 and a half. So it can be set up as a traditional, which is basically means that something is put in there pre-tax for immediate tax savings. You get to take the tax deductions this year, or you can do it after tax with a Roth option, and that means that it's paid tax. You've paid taxes on it now, but down the line, when you take your withdrawals out, you don't have to pay taxes. So on a traditional, you pay tax, you take a tax deduction now, and you pay taxes when you pull the money back out of the account, versus a Roth, you pay taxes now, but you don't pay taxes on the back end when you pull the money out. Now that can go either way. It really depends on, some people are in a higher tax bracket. The majority of people are in a higher tax bracket in their working years than they are in their retirement years. There are individuals who are in a lower income tax bracket in their working years and a higher income tax bracket in their retirement years. So this is one of the ones that where tax planning actually really comes in, because you're more concerned with the marginal income tax rate or having a tax strategy. If I have the money inside a tax account, what's the smartest strategy for me to pay myself my money back and lower my income taxes? And that's one of the things that there's some great tax planning software out there that can really work on for your individual circumstances. But of course, tax laws always change, so it's up to what you think government will look like 20, 30 years from now, so, or 10, 20 years, depending on when you're retiring. A SEP IRA, as a short, versus a solo 401k, is a simplified employee pension plan, and it is available to any small business owners, including sole proprietors and freelancers. Contributions are made only by the employer, which creates means for the business. You can contribute up to 25% of your net self-employment income, capped at $69,000 in 2025. But there is no Roth option like there is in a 401 solo 401k. So who is eligible? Solo 401k, you must be self-employed with no full-time employees except a spouse. A SEP IRA is available to self-employed businesses, partnerships, corporations, even if you have employees. However, if you have employees, you must contribute the same percentage of salary for them as you do for yourself. So here's a kind of a quick glance, kind of an overview. Um, a solo 401k is best for self-employed people with no employees. A SEP IRA is self-employed or small business owners with or without employees. Maximum contributions is $69,000 for both a solo 401k and a SEP IRA. The contribution source inside a solo 401k is the employee and the employer, and a key difference inside of a SEP IRA, it is the employer only that makes the contributions into the account. Loan provisions in a solo 401k, yes, there are in some plans. In a SEP IRA, there is not. Setup deadline, December 31st for a solo 401k, and by the tax filing deadline of a SEP IRA. Filing form for the solo 401k is a form 5550 in assets of 250k, 100k or less or more. There is SEP IRA, there is no tax filing requirements. Complexity, solo 401k is a little bit more complex, and a SEP IRA is probably one of the easiest to set up. In both of these, contribution and limits. For a 401k, we kind of went a little bit over that. Let's go into I think one of the things a lot of people get confused about in this is like, oh, well, I can put the money in. Well, technically, what is a contribution limit calculation, and what is your net self-employment income? So let's take a look at this. You're calculating your self-employment income for retirement income. For example, for a solo 401k or a SEP IRA, your contributions are based off your net self-employment income, not just your Schedule C net profit. So here's how someone might go through and calculate that. They would start with their net profit on their Schedule C or line 31 or equivalent. You'd subtract half of your self-employment tax off of your Schedule SE, and then you adjust for the other deductions. So your net self-employment income is equal to your net profit minus 1/2 times your SE income, SE tax. So for a solo 401k, if they were up to 23,025 based on a gross SE, employer contributions up to 20% of net SE after tax deductions. And a SEP IRA is 20% of net self-employment or same employer calculation as a solo 401k, but no other deferrals. So let's take example of someone that earned $100,000 minus 1/2 the self-employment tax of $7,065. So they have 92,935 net self-employment tax. They do a 20% employer divided by SEP limit, gets us 20% of the 92,935, gives us a max contribution of 18,587. So key point to remember is you always have to make sure to take out that self-employment tax before applying the 20% rule. And remember, a solo 401k offers an extra employee deferral, allowing for higher contribution limits at lower incomes. Tax implications. So a solo 401k and a SEP IRA both are deductible, lowering your taxable incomes in the contribution year. Both accounts grow tax-free. Withdrawals before age 59.5 incur a 10% penalty, just like all the other penalties, and requirement distributions begin at age 73 for both plans. So what are some of the advantages that a Roth might have for creators? For a Roth, let's take a look at the tax treatment. If you're a creator and your incomes tend to grow over time, and you think that you'll be earning more in retirement when you start pulling money out, then that's someone that might be a great situation for someone to look at a Roth versus a solo 401k. And if someone thinks, you know what, I'm not going to be doing any creating, my income's going to go significantly down in retirement, then that is someone who might strategize and say maybe a solo 401k might fit me a little bit better. But that's just part of the questions to ask. Tax treatment and withdrawals. So um, pre-tax conditions for a solo 401k, yes. Roth contributions, yes, in a solo 401k. A SEP IRA is just a straight traditional tax deferred account and does not have the Roth option currently. And the other big number is retirement of age 63. And if you try to take a loan or take any money out, that you're going to get taxed as normal income tax plus a 10% penalty tax on it. So you really do not want to be taking money back out of these accounts. That they've been incentivized for you to keep the money in there until you withdraw after 59, until you make the withdrawals after you retire or age 59 and a half. Administrative requirement costs. 401k must be established by December 31st to make contributions for the years. More paperwork than a SEP IRA, and you have to file Form 5500 once plan assets exceed 250,000. A SEP IRA can be set up as late as your tax filing deadline. So, which should you choose? Pros and cons. Solo on 401ks. A little bit up here. We'll go. A solo 1K might be best if you want to maximize contributions with both employees and employer roles, and you want a Roth option. You may need the option to borrow from your plan or provisions. A SEP IRA might fit you if you want a simplest, fast cleanup and fast setup and minimal or no paperwork. Minimal paperwork. Have employees and you want to contribute for them. Prefer to wait until the tax filing to decide how much you want to contribute. And this is something that I think just not doing in 1 year, but making out saying I'm going to be planning this for multi-years as a retirement plan. So it shouldn't be something that you make on a short, I wouldn't be something that I would recommend making on a short-term basis unless there was some need to, but a retirement plan should be based on your long-term needs and what you're going to plan over the years and decades and how you contribute to this. You might ask yourself some questions like, do you have any employees other than your spouse? Is maximizing contributions at lower income levels important to you? Do you want a Roth options for tax-free withdrawals in retirement? Are you willing to handle a bit more paperwork and potential annual filings? Do you want the option to borrow from your retirement plan? Do you prefer to decide on contributions after year ends? And will your income fluctuate from year to year? Quick look on the IRS tables for rules. Solo 401k needs to be set up by December 31st. Funding deadline and employee contributions by December 31st of the tax filing year. And funding deadline for employer contributions, tax filing deadline including extensions, and filing requirements Form 5500 EZ, and a SEP IRA, you tax filing deadline including extensions, and funding the employee contribution is by the tax filing deadline including extensions. Examples for a couple creators. So let's take a look at a YouTuber here that makes $120,000 in net profit. He runs a full-time YouTube channel covering tech reviews and earns $120,000 in net self-employment income. He can make the maximum employee deferral of $23,000 for the employee deferral and add an employer contribution of $24,000. So this is a total of about $47,000 in retirement savings for the year. If they were to do a SEP IRA, Alex can contribute only as the employer, capped at a 25% self-employment income or about $30,000. So, and a solo 401k allows him to put about an additional $17,000 a year away. And then once we take a look at that money that's away, the next question you ask is, do I want, when you're looking at, do I want to do a Roth strategy or a traditional strategy? The question starts coming down to a marginal income tax questions and some other tax questions that are in there. That do I want to pay taxes now or in the future? And that really should depend on where you think taxes are going to go, and that's one for beyond this video. Part-time photographers for option 2. Jamie is a part-time wedding photographer with $40,000 in net profit. Solo 401k can make Jamie can make the full employee deferral $23,000 plus an employer contributions of about $8,000 for the total contributions of about $31,000 or 70% of their net income. In a SEP IRA, Jamie can contribute As an employer, 25% of 40,000 or only about 10,000. The result for someone on moderate earnings, the solo 401k is far more powerful, allowing a much higher percentage of income to be saved and deducted on taxes. Of course, this also depends on how much you actually need to save or how much your expenses are. So, take a look at your budget and your strategies and what's going to work for you. Scenario 3 is a small creator business with one employee. Taylor is a graphic designer with $85,000 in net profit and one assistant earning $40,000. The full 401k is not an option because having a full-time employee other than a spouse disqualifies Taylor. He has a SEP IRA. Taylor can contribute $25,000 of net self-employment income, but he must also contribute 25% of the assistant's salary into the retirement account into the SEP for the employee. A traditional safe harbor plan might be a better option for someone in this type of case, while using a more comfortable employee match instead of the 25%. A simple IRA also is another option that also offers employer costs, requiring only up to like a 3% match or 2% non-elective contribution. So the SEP IRA is still the simplest choice, but Taylor should weigh the high employee contribution cost against alternatives that can better benefit the owner and budget constraints. And this comes down to what's the goal of the employer and what are you trying to do with your account and how do you compensate your employees if you end up having more than one employees. SEP IRA up to 25% of the net income. Same percentages required for all employees, 25% of 40,000, for example, up to 10,000. Low, simple to set up, no annual fee filing. Simple plan with high owner contribution, but equally percentage to employees. A simple IRA is another plan. Up to $16,000 deferral with $3,500 catch up for 50 and above. Match up to 3% of pay for $1,200 for the assistants, or these are safe harbor plans, or a 2% non-elective safe harbor provision. Low, easy to set up annual maintenance. Low cost options with modest employer outlay is preferred. A safe harbor 401k is up to $23,000 deferral for the employee and $30,000 for the employer. So we're looking at about $53,000 to be able to put away into a safe harbor for the $53,000 in a safe harbor 401k. Typically 3% a non-elective or a 4% match for employees. Moderate requires plan, admin, and annual findings. Max owner contributions while avoiding non-discrimination testing. How to set up your accounts. You can go look at that. Pretty much Vanguard, Fidelity, Schwab, a lot of different companies are doing that. Tax advantages of a qualified retirement plan. Both the solo 401k, a SEP IRA are tax qualified retirement, meaning they qualify for IRS tax advantage deferral savings. For contract waivers, immediate tax savings, both are on the SEP IRA and the traditional solo 401k, or you can end up doing something like the Roth earlier that we talked about. The tax deferred growth inside the accounts. They also allow a little bit of flexible tax planning with a solo 401k. You can split contributions between pre-tax and Roth tax. So you might do a 50-50 example, giving you some flexibility to manage taxable income now versus in retirement for lifetime tax management. SEP IRAs are strictly pre-tax, but still allow you to manage your current tax liability by choosing contributions amount. One of the things I want to talk in here is a little bit about marginal income planning and the power of tax deferral. One of the lesser discussed benefits of tax qualified plans is the marginal income planning. What this means is your taxes, you're not taxed the same amount on every dollar. Your tax rate goes up as you earn more because U.S. has a progressive tax system. So what you want to do is figure, depending on where you are in those income tax brackets, you may be smart to say, I'm going to be a high income earner, but I'm going to be lower year, or I have lumpy years of income in how I'm going to earn that, to where I put more into the account when I earn a lot and less when I don't earn as much. But when I pull that tax out, I can take and pull those accounts out from in a strategic way so that I have a low income year. I can pull more money out of that account and pay a lower income tax on it. So you also want to look at the marginal income. The big one is like, are you going to be at a higher marginal income tax rate in retirement or a higher marginal income tax rate now? That's one of the big things that gets into putting money in a tax qualified plan. So a little bit about that. Final thoughts. Both of them are great options. Hopefully, give you some ideas. Leave some ideas in top comments. Some people, there's a lot of things that you can't